Welcome, everyone, to FX Street. It's 2 p.m. Eastern, 1800 GMT. Welcome back, one and all. Great you could join us. In 15 minutes, we have a Federal Reserve meeting. The Federal Reserve is scheduled to report their interest rate decision in the next 15 minutes or so. That's at 2:15 p.m. Eastern. They're expected to keep the rates unchanged. That's expected by all, the 0 to 0.25% level. And furthermore, most analysts are expecting the Fed to not initiate any changes in terms of their other monetary policy. Now, typically, when we talk about monetary policy, in the past, we would only think about interest rates, raising interest rates, lowering interest rates, or keeping them unchanged. Over the past couple of years, the Fed has really expanded its role. Some criticism that they've enacted other measures, quantitative easing 1, quantitative easing 2, Operation Twist. Some, not all, but some do expect the Federal Reserve will initiate quantitative easing 3. Others expect that they will further their last operation or continue their last operation, which is known as Operation Twist. So what we're going to try to do is discuss, all the different realms and possibilities of what the Fed could do and what are the possible market implications. By the way, we're looking at the chart of the Dow Jones Industrial Average. 13,065 Dow Jones futures. We hit highs earlier today of 13,081. That's on a futures basis. And by the way, 13,081 is the highest level. We'll go to a weekly chart here. The highest high we've seen going back to the highs of 13,137. And those were achieved in May of 2008. Imagine that. We've made back all the gains, all the losses, I should say. We've made back all the losses from May of 2008, the entire financial crisis, at least in terms of the stock market. But then again, maybe not. And we'll talk about that. We'll talk about that as well. By the way, take a look at this if you have not noticed already. This is a very interesting chart, which you'll see in just a moment here. This is known as the VIX, the Volatility Index, also known as the Fear Index. This is from Yahoo Finance. And I'll send everyone the link as well. If you just go to Yahoo Finance and type in VIX, V-I-X, I think that's the link that should give you the charts. It's a volatility index. It's currently indicating a level of 15.04, although we did hit lows today of 13.99. The question is, how do we trade the VIX? It's a very good question, and I have a definite answer for you. The volatility index, also known as the fear index, measures approximately the price of options on the S&P 500 index. Calls and puts, it doesn't matter. Think of this. Most traders, most investors who buy stocks, they don't buy and sell stocks, meaning they don't buy if they think it's going to go up and then sell short if they think it's going to go down, not like we do in Forex. Most people in the stock market, buy stocks and buy and hold. They buy stocks in their 401k plan, pension plan, IRA, or they just simply buy 100 shares of Apple Computer and hope that they keep on continuing to make a million iPads every time they make a new one, or more than a million. So when stock markets go up, we tend not to, most of us don't use options. When stock markets go down, we tend to use options. We sell covered calls, or we buy protected puts, or any number of other option strategies that use options to protect our long-term investments. And therefore, the premiums, the prices, the extra price that we pay for those options goes up as the stock market goes down. There are two magic levels that we talk about with the VIX, 15 and 40. When the VIX gets down to 15, it means that almost no one is using options to protect their positions, their stocks. And because of that, we tend to think that the market is very vulnerable, that everybody's very complacent, everybody's very comfortable, that we think that the market is just going to go up and up and up. I mean, after all, we're above 13,000 now. stock market is up another 107 points today. If you just look at the price of the stock market, there's very little reason to believe that it'll go down. Well, the VIX identifies those extreme levels of complacency or comfort. Generally speaking, when the VIX hits 15, it means that everyone is very, very comfortable, probably too comfortable, and it's usually a great time to sell the stock market. The last time the VIX hit 15 was May of last year. Dow Jones and the average, May of last year, was, and I'll show you on the chart, was here. Let's go on a fresh chart here. Okay, this is the Dow Jones Industrial Average. In fact, I have some lines here. This is May of last year, basically right over here. That's the last time, the first white line, the first vertical white line on the left-hand side, that's May of last year. That's the last time the VIX hit 15. Dow Jones Industrial Average hit a high, 12,919, May 2nd. Everything looked great. Well, everything went from looking great to looking not so great very, very quickly. Now, the VIX also hits extreme high levels like 40. And when the VIX hits 40, it means that most traders or most participants in the market, not most, but so many traders have bought protective puts or sell covered calls or done something to protect their options, to protect their positions or stock positions, that basically it doesn't matter if the stock market goes down anymore, because if the stock market goes down, we're hedged. And that's usually a great time to buy stocks. In other words, sell stocks when the VIX hits 15, buy stocks when the VIX hits 40. The last time the VIX was at 40, we hit highs of just above 40, 45. And that was August of last year, August 5th to be exact, August 5th of last year. So the VIX told us to sell stocks in May, it told us to buy stocks in August. The second white line we drew in August 5th of last year, stock market hit a low, Dow Jones Industrial Average hit a low of 11,359. It told us to sell stocks at 12,900. It told us to buy at 11,300. Now, we did go a little bit higher and a little bit lower. It's not going to find the exact date, but it comes pretty close. For the first time since May of last year, this morning, the VIX broke below 15. We hit 1399. Now, the VIX hit its high. The VIX hit its low, I should say, 1469, April 21st. Sorry, April 21st. Now, the stock market did not hit an all-time high until May the 2nd, and did not actually crash until August. So it's not an indicator where it gives us a trade today and we can expect it to work tomorrow. But it's pretty good at finding these very extreme levels. I think the VIX has identified another extreme level. Again, we don't know if it's going to happen today, tomorrow, or 3 months from now. But I would be on the lookout for major market reversals. And in terms of foreign exchange pairs, well, very simply, and again, it's not an exact correlation, but we think of selling in May and buying in August. By the way, that expression, sell in May and go away, it seems to ring true. That's an old stock trader's expression. Here's the Aussie yen. What do we say? April 28th, I think? Yeah, April 21st. Here is the Aussie yen. Let's mark off a little bit of a thick line. That's when the VIX told us to sell stocks. The Aussie yen hit a high of 88.59, 88.55, I should say. August, what was it, August 2nd, I think? August 5th? I forget exactly. Right around there. We hit a low of 82.40. So the VIX basically told us to sell the Aussie yen in 88 and near 8,800 and to buy it near 8,200. Not too bad. Euro dollar, same situation. Not exactly though, actually. Here's the euro dollar. I picked the Aussie yen, by the way, because it's an easy comparison. Here's April 21st, I think was the date we're talking about. Euro dollar. Actually, not too bad. August 20, I forget exactly what the date was. August 8th or August 5th. It captured a nice piece of the euro dollar, but not the whole thing. The reason why I picked the Aussie yen is because the Aussie is the highest yielding currency and the yen is the lowest yielding currency. So when stock markets go up, we have risk appetite. On TV, they call it risk on. We feel like taking risk. We have risk appetite. And therefore, we buy higher yielding currencies like Aussie with 4.25% interest rates. We sell lower yielding currencies like the yen, which has a 0 to 0.1% interest rate. Euro dollar, well, euro has 0.5% interest rates, and dollar has basically 0% interest rate. The spread, the difference between the interest rates of the two currencies, it's not that great. It's less than 0.5%. So the euro dollar is not going to move so much under the basis of risk on, risk off. It's more going to move under the basis of U.S. economy versus European economy. Now, I think a scenario that we could run into a scenario of a very strong dollar, and I'll tell you why I think that. To answer your question, before we get sort of flooded with Federal Reserve data over here, how to trade the VIX? Well, the VIX being at 15 leads me to believe, and again, it's my own opinion, I've been wrong in the past, especially shorting the market, but with the VIX near 15, this leads me to believe that we should short stocks and short higher yielding currencies like Aussie and Kiwi, and go long lower yielding currencies like the yen and maybe the dollar. It really depends what the Federal Reserve says in a couple of minutes from now, but maybe the dollar. So one trade is to take a long-term trade, shorting Aussie yen, Aussie dollar, Kiwi yen, Kiwi dollar. I would, actually the yens and the dollars, we really don't know until the Federal Reserve says what they're going to say. The really big question is quantitative easing 3. Let me actually type some of these notes in. Okay, so the first question that we want to hear from the Fed is FOMC to leave rates unchanged today. That I think everyone expects. The Federal Reserve is not going to do anything. Why would they raise rates? We're not having any kind of economic trouble so far. What is the chance the FOMC, Federal Open Market Committee, will raise rates by the end of 2014? The Fed Funds futures did indicate during, I think it was the last meeting or it was the last non-farm payroll. I think there's, I can't remember exactly the number. It's around 60% chance. 60% chance that they'll raise rates by the end of 2014. Dollar yen, I'll answer the question. Dollar yen depends on quantitative easing 3, which is point number 3. Will the FOMC initiate QE, which is quantitative easing 3? Now, if the Fed does initiate quantitative easing 3, remember quantitative easing 1, quantitative easing 2. That's where the Fed printed massive amounts of money in order to fund the purchase of long-term treasuries. They bought long-term treasury bonds because as they buy the bonds, the price of the bonds goes up, but we don't talk about bonds in terms of price. We talk about bonds in terms of yield, and there's an inverse or opposite correlation. When they buy the bonds, the bond price goes up, the yield goes down. The Federal Reserve wants the economy to recover. They want people to spend. They want us to buy homes and automobiles and refrigerators and anything else that we use credit. And to do so, they're keeping interest rates as low as possible. By number 1, they lowered interest rates to 0. That wasn't enough. Now they initiated quantitative easing 1 and quantitative easing 2. They purchased long-term treasuries to keep interest rates low. If they initiate quantitative easing 3, that will be the 3rd round of quantitative easing. And the foreseen consequence is to keep interest rates low. The unforeseen consequence is that they printed so much extra money, it's diluted the dollar. Meaning every dollar that we have, every dollar that you have in your bank account, well now there's more dollars out there in the world that your dollars have to compete with. So your dollars have a little bit less buying power. That's why when the dollar goes down, by the way, gold goes up. Gold has an opposite correlation to the dollar. So we're also going to watch gold very carefully. Okay? Opposite to the U.S. dollar. Now, if the Federal Reserve, let's say they're going to come out in a couple minutes, so I want to talk quickly. If the Fed comes out in a couple minutes and they say, we're initiating QE3, we're going to have QE3, I think, number one, that's bad for the dollar. I think the dollar goes down. I think gold goes up because gold is the opposite of the dollar. And this quantitative easing is stimulus for the economy. Well, how do we know? How do we see? By the way, I'm reading the Fed Reserve statement right now. I'm going to try to talk and read the statement at the same time. By the way, 208 is a bond yield. Okay, so as the Fed meets, it's important to watch Met 10-year U.S. bond yield 2.08%. Okay, we're going to watch that. We're going to compare it afterwards. Now, let's see over here what these. I have a lot of statements over here. Okay, Fed keeps Fed funds range 0.00 in the quarter. That's expected. Voted 9-1 for Fed funds rate action. The discount rate unchanged 0.755%. So far, no change. Nothing unexpected. The economy has been expanding moderately. Further labor market improvements. Unemployment rate has declined notably, still elevated though. Household spending, business investment advanced. Sector remains depressed. Oil and gas prices have increased, inflation subdued. I don't agree with that. Long-term inflation expectations stable. Expects moderate economic growth in coming quarters. I'm reading just from the notes from the Fed statement here. Unemployment rate will decline gradually. Global financial strains have eased, still pose significant risk. Oil gas prices increase will push up inflation temporarily. Fed sees inflation at or below target level. Expects to maintain highly accommodative monetary policy. It's getting interesting now. Fed funds to stay exceptionally low at least to late to 2014. To continue extending maturity of securities, that's important. So we're going to talk about that. Maintaining plan to reinvest mortgage debt principal payments. To regularly review size composition of holdings. Lack or dissent doesn't see need for low rates for 2014. Okay, so to recap from what we've seen so far, I'm waiting for the Fed fund futures. But the Federal Reserve kept rates unchanged as expected to 0 to 0.25% level. They see inflation is nothing to be concerned about. At or below target level. They say unemployment has improved, but still we're not out of the woods yet. And most importantly, so far, maintaining plans to reinvest mortgage debt principal payments. They're talking, if I'm not, and oh, by the way, expect to maintain highly accommodative monetary policy. Okay, now this is important. That's Operation Twist. We're going to talk about Operation Twist in a second. By the way, 10-year bond yield was at 208, now at 207.6. The 10-year bond yield, we're going to come back to the bond yield in a moment. But the bond yield is starting to sell off, which would lead me to believe, let's go back to the Dow charts, which would lead me to believe that the Dow Jones Average is also going to sell off, if I'm not mistaken here. Daily, let's go to a 5-minute chart. This is the Dow. Actually, you know what? The better currency pair to watch, ironically, I think is the dollar yen. Don't ask about the dollar yen. It's worth watching. Dollar yen's going up, and I'll tell you why. Okay, if the Federal Reserve were to say just a few minutes ago that we're going to do quantitative easing 3, that would be bad for the dollar because again, more quantitative easing, more competition for our dollars. That is the reason why gold is so strong. It's not because of Iran. It's not because of geopolitical tension. I mean, I know that the textbook definition of gold in financial markets is war and geopolitical tension, but that's very, very short-lived. Gold goes up one day, the day that a war starts. That gold has not gone up over the past 10 years as a result of geopolitical tensions. Gold has gone up over the past 10 years as a result of a weakening dollar. And as the U.S. going from a trade surplus to a trade deficit, gold moves as it hedges a falling dollar. If you want to see the true value of your money, don't look at the Dow Jones Industrial Average 13,000. Look at the Dow Jones Industrial Average divided by the price of gold. It's a really, really interesting calculation, and we have some time left to go through that as well. I think as long as the Fed, to answer your question regarding the dollar yen, I think the dollar yen is an excellent currency pair that will to go up long term if the Fed does not initiate QE3, because it means that the amount of dollars that we have right now in circulation, that's not going to change. We're not going to print any more dollars. Number two, it means that the economy, at least to a small extent, is recovering. And that means the Federal Reserve one day will raise interest rates. And right now, in Japan, you have interest rates, your JPY, 0.0, it's actually 0 to 0.1% interest rates. That's Japan. The U.S. right now is 0 to 0.25%. It's basically the same. Okay? But if the economy improves, remember, interest rates in 2006, 2007 were 5.25%. So if the Federal Reserve does not initiate QE3, it means that, well, the dollar is not going to be diluted anymore. Now, you're probably going to have, we have the chance to see the Federal Reserve will not initiate QE3. From what I've read so far, we are not going to see QE3 from what we know right now. Of course, everything could change. But from what we know right now, there's not going to be QE3 according to the Federal Reserve statement that we read. And I think this would do very, very well for the dollar yen to the upside. Because right now, the dollar yen is at 82.77. And a lot of that price has to do with the relationship of no difference in interest rates between Japan and the U.S. But if the economy recovers, no QE3, we could see a real surge one day in interest rates in the U.S. Not today, not tomorrow, but by late 2014, they say that the Federal Reserve is going to keep interest rates near zero. Now, I think the Federal Reserve will raise interest rates before the end of 2014, but I think that we have to see a lot that has to change in between now and then. That figure, the Fed funds futures that tell us there's a very small chance, that's given the situation that we have right now, and given that the situation probably won't change too much in the near-term future. But I think by the end of 2014, I think we'll at least see a really good expectation that the Federal Reserve will raise interest rates. Now, if you want to look at a really interesting chart, you look at the dollar yen from a monthly basis. Take away all these lines. There's a very long-term trend to the downside in the dollar yen. Now, I think the dollar yen could enjoy a tremendous move up. And if you take a look at last month's candlestick, we actually broke a pretty significant trend line, a trend line going back to August of 2008. But I don't necessarily think that the dollar yen is that all of a sudden, we're going to start to see the dollar yen trade at new highs, 148 that we saw. I don't know necessarily the dollar yen is going to do that. We need to see the Federal Reserve go from a budget, or I should say a U.S. trade deficit, not the trade deficit, but our budgets. We need to go from a budget deficit to a budget surplus. We have a $1 trillion deficit on a yearly basis. We have a $15 trillion debt overall. We need to see that debt turn to a surplus. Then I think you see the dollar yen start a huge multi-year, maybe multi-decade rally to the upside. But we're $15 trillion away from that happening. I mean, you look at the last time that the dollar yen was actually in an uptrend, we hit a high in 1998. But what happened in the late 90s? We went from a budget surplus to a budget deficit. This is the reason why I think the dollar yen went from going up to going down. That all of a sudden, with a budget deficit, our dollars are worth a little bit more. Think about it on a personal basis. Let's say we have a salary every month. We have a salary we don't make a lot of money. We make $1,000 a month. Now, if we have a budget surplus in our own personal finances, that means I make $1,000 a month. I pay my rent. I pay my insurance. I buy some food and all that other stuff. And I'm able to save $5 a month. Now, it's not a lot. So $10 a month, 1%. I have a budget surplus of 1%. So if I spend some money, it's okay because I have surplus and I have a positive cash flow, so to speak. Now, if I have a budget deficit, it means I make $1,000 a month, but let's say I owe my credit cards $100. Every dollar I make, a little bit of that has to go to pay off not the credit card bill, just the interest. That means that every dollar I make is worth a little bit less because some of it has to go somewhere else to pay off interest on some debt. That's why it's always good to try to live our lives out of debt, not without credit card bill. Now, there's a careful balance. I'm not going to get into a whole, I don't want to lecture everyone on personal money management, but there are times to extend yourself to take debt. If we buy a house and the housing market's very, very weak, which it is in a lot of parts of the world, I think that's a good time to go into debt, to, invest in an asset that has the potential to make more than our interest payments on our credit cards. For us to use our credit cards to buy a flat screen TV and the TV is going to do nothing but lose value, that's a different story. Well, that's what we're looking at right now. We have a budget deficit, and that's why the dollar-yen still has a steady trend to the downside. By the way, Fed funds futures see a 74% chance for an early 2014 rate hike. And that's higher than it was before the meeting. I don't know what it was, but that is an improvement. Here's from the Dow Jones News Tape. FOMC stays silent on the possibility of QE3, but it does strike an improved, better note on the economy. Its statement says labor market conditions have improved further, and the unemployment rate has declined notably in recent months, but remains elevated. Better economic data recently have raised the odds against further easing, but it has not taken it off the table completely against further easing. Okay. So, by the way, for those of you that joined us during our webinar this morning, we talked about trading economic numbers. Now, I'm gonna mark these lines off, this price level off. Make a mental note. Dow Jones Industrial Average 13,080 right now. The 10-year bond yield at 2.08%. This is good news, but this is also giving us, this is telling us what news to watch for in the future. The statement we just read right now, it says labor market, let's see here, unemployment rate has declined notably in recent months, but remains elevated. That means the Fed wants to see the unemployment rate continue to drop. It says the economic numbers have improved. Labor market conditions have improved further. And overall, the economy has improved. We want to see, and I would say that the three big numbers to watch are unemployment. I know I'm kind of going all over the place here. GDP, CPI. We want to see those numbers improve, and then I think you see the dollar continue to rally. Let's go back to a 5-minute chart of the dollar yen. I think the dollar will rally if these numbers improve because it means that now we're not looking at the dollar, we meaning the Forex market. We're not looking at the dollar in terms of its low yield, it's a flight to safety, and let's sell the dollar because I want to buy the Aussie. Now we're looking at the dollar like a really good value play. Remember those stocks? If anybody bought Ford Motor Company when it was $2 a share, the stock went from 2 to 20 in 2 years. That's a value play. I think the dollar is now a value play because now most of the downside, I think, has been priced into the dollar. And now, what are the chances that the Federal Reserve is going to lower interest rates? Well, they can't. What's the chances that we're going to see QE3? Right now, probably not. What's the chances that the Federal Reserve will raise rates? By 24, ask yourselves a question. Between now and 2014, what's the chances that the Federal Reserve will either initiate QE3 or raise interest rates? I'll ask all of you. I have a big room here. So by 2014, which scenario do you think is more likely? QE3 or FOMC will raise interest rates. Okay. I'll ask all of you. I think they're going to raise rates sooner than QE3. There's a lot of us in the rooms right now. Now, Fed Fund futures say there's a 74% chance that the Federal Reserve is going to raise interest rates. And so far, they said we're not going to see QE3. Well, we've had, and I haven't voted, but I will vote, and I would say also to raise interest rates. So 5 out of 5 people so far that voted in our little unscientific poll have voted that we see the more likely the Federal Reserve will raise interest rates rather than QE3. To me, that tells me to buy the dollar. Now, the question is, what do we buy the dollar against? Because we're Forex traders, we have to consider the other side of the trade. Do we buy the Aussie? Do we buy the Kiwi? Do we buy the CAD? Well, let's consider the other side of the coin. If it means, if the Federal Reserve, and we're looking forward a year to a year and a half, 2 years from now, and we're not going to have QE3, but we do have a very strong chance the Federal Reserve is going to raise rates, that means the economy is going to get better in the U.S., probably better in a lot of other places. What currency do we sell short against the dollar? We want to sell short a currency. We want to sell short a currency that, before you type in your answers, I know you probably have some really good answers. I want to just type this in. A currency that either has low interest rates now, has a good chance to lower interest rates in the future. Low interest rates, and little chance they will raise interest rates before the U.S. does, meaning the Fed. What else? Basically, we have to make a comparison. Now, I would not necessarily buy the dollar yen right here. I mean, look, to find the actual trade signal, if you're looking for a short-term trade, I would identify a short-term pullback. Long-term trade, long-term pullback. But fundamentally speaking, based on what we've learned right now, yeah, I think the dollar yen going up, I think we have a very good chance to see the dollar yen experience a nice trend to the upside in the near-term future and in the long-term future. I mean, we can look at, we can look at the charts and look for recent supports. Here's a 4-hour chart, dollar yen. Just to give you an idea of what we would look for, dollar yen, draw uptrending supports. We could look at something like this, 81.30 dollar yen. We could look at another trend line as follows, 8,100. I mean, I think that's a good basis to start. We can also look at a former resistance. That could become new supports higher up near 82.13. But yeah, I mean, I think the dollar yen has a really good chance to go. I would not necessarily buy it right here. I don't like to be the last guy in the trade. The dollar yen's already going up. I'd like to be in the dollar yen before it goes up, so we can make money in this trade. If we buy it right here, we're not making money. All we're doing is taking a lot of risk. But long-term, short-term, let's think long-term. If we think the dollar yen's going to go up, if we think the dollar's going to go up, I just give my answer away. What currency would we sell short? Well, it's a process of elimination. I don't want to sell short anything with high yields because I think if the U.S. economy improves, we're going to have a risk appetite. We're going to want to buy risk because risk pays when things are good, when times are good. So that means Aussie and Kiwi has higher yield, the highest yield. I don't want to sell short Aussie Kiwi. So therefore, I don't want to short Aussie dollar or Kiwi dollars. Take that off the table. Pound dollar. Well, the British pound has low interest rates. But what is the chance that the Bank of England will raise interest rates before or after the Federal Reserve will raise rates? I think that the Bank of England, I wouldn't say they're necessarily going to raise rates after the U.S. I would guess. I don't watch the economic data as well as I really should. There's so much of it. But I think, based on what I've seen, I think the Bank of England is closer to raising rates than we are. I don't think they're going to raise anytime soon, but it's not a very complicated economy. And I think that the Bank of England, there's a lot of tailspin risk from what's happening in Europe. I think that as soon as things start to get a little bit better in Europe, I think the Bank of England is going to find itself in a much better position. They did initiate their own version of further stimulus, but then again, we did too. So I guess that cancels each other out. So the pound dollar is not necessarily a good short. The euro dollar, I think the euro dollar is a good short. I think that the European Central Bank is probably the one central bank out there that could still lower interest rates. I don't think we're done with Greece. I think that Greece defaulting, I think this is something that the European Central Bank was trying to avoid. Obviously, they were not able to avoid it because the credit default swaps were triggered. It's basically a safety net in case of a default. We did default in Greece. And I don't want to be an alarmist and say that it's going to spread, but there is a risk of that. The debt contagion will spread. And we're talking about other countries like Spain, Portugal, Italy, and Ireland are pretty vulnerable. And there's rampant unemployment in Spain. 25, almost 30% unemployment in Spain. That's not good. So I don't see things in Europe getting better anytime soon. I don't know necessarily if I want to go along with dollar CAD because Canada, first of all, the Canadian dollar has been quite strong. Canada benefits from a high price of oil. Oil at $107 a barrel for light sweet crude oil, that's helping Canada every single day. Plus, Canada, I think, has been held back, number one, because of the U.S., number two, because of Europe. I think that and especially then we can now take into consideration geopolitical risks. If there's any kind of risk of future war in the Middle East, that would bode well for oil to go higher, and then that in turn could benefit the Canadian dollar. So I don't want to go along the dollar CAD. I don't want to buy the dollar and sell short the CAD. So we've eliminated the Aussie, Kiwi, pounds, and CAD. Now, that brings us to what's left. The Swissy, the yen. Is there something else out there I'm forgetting? I think the Swissy and the yen. I think the dollar Swissy and the dollar yen are excellent currency pairs to anticipate long-term trends to the upside that may emerge if the dollar continues in its current climb higher. By the way, 10-year bond yield was at 2.08%. We're now at 2.10%. And that's probably the highest yield we've seen in a while. Bond yields tend to move in the same direction as the stock market. The bond yield has gone up since the Fed meeting. That means that the bond market likes this. Now, the bonds are actually going down, but this shows optimism out there. I think, let's talk about the dollar yen. The Swiss National Bank has intervened in the dollar Swiss on the Swiss currency, actually the Euro Swissy. Switzerland is an export-driven economy just like Europe. I'm sorry, not Europe, Japan, and like Germany. That's what I was thinking about Europe. So Germany, Japan, Switzerland, these are economies that tend to do well when their own currency is weak. So they don't mind if the dollar Swissy goes up, and they don't mind if the dollar yen goes up. And in terms of Germany, Germany does not mind if the euro dollar goes down. Euro dollar goes down, all of a sudden all those BMWs and Mercedes and all those other products that Germany exports, those become cheaper. BMW becomes cheaper for me in the U.S. if the euro dollar goes down. So in Germany being, and we had some really good German investor confidence numbers earlier today, the Zoo number, the euro dollar goes down, that's good for Germany. So we're not exactly going to see a big argument down. As far as inflation, well, oil and food is expensive. But aside from that, I don't think we're seeing a lot of inflationary pressures anywhere. Is dollar Swissy, dollar yen a good pair for long term, at the moment? At this very particular price, I wouldn't say no. I don't want to necessarily buy it. We see the dollar yen's pulling back. Dollar yen, I think a good spot to go long on a medium term basis might be 8,200, if not 81. Dollar Swissy, here's dollar Swissy. Here's a 4-hour chart. Let's get rid of all these lines. 4-hour chart's a nice compromise. And, of course, resistance. Well, that's a pretty nice channel right there. That's a dollar Swissy 4-hour charts. That's a pretty good way to go about it. I don't know necessarily if the dollar Swissy is going to come back all the way down to 90, 95. We'll call it 9,100. But it's a nice entry, or maybe a steeper uptrending support near 91.50. Dollar Swissy, I would say 91 and 91.50. I don't want to buy it right here. You know, it's tempting to see the dollar Swissy going up, but again, if I buy the dollar Swissy right here, I'm not making money. All I'm doing is taking risk. This is my potential reward given what the charts show me. We don't know if the dollar Swissy is going to break out. All we know is what's happening inside the channel. We have this much risk and this much potential reward. So it's not a good spot at the moment to buy dollar Swissy, but the trend is your friend. So write down a piece of paper and wait for the dollar Swissy to pull back. I promise, the market always pulls back. You know, we always get a second and third chance to get inside, to get into a trade. So I think the dollar Swissy, dollar yen to the upside, and euro dollar to the downside are my three favorite trades, assuming, number one, economic numbers continue to improve, number two, no QE3. Now, the Fed talked about something else, where they're still very much willing to initiate further rounds of stimulus and to reinvest in treasuries. The Federal Reserve is involved in something right now called Operation Twist. This is very, very interesting. What's the difference between Operation Twist versus QE, quantitative easing? Can anybody tell me? What's the difference? We have quantitative easing 1 and quantitative easing 2. Federal Reserve printed massive amounts of money to buy long-term treasuries in order to keep interest rates, real interest rates, as low as possible. Those are the intended consequences. The unintended consequences is that all those extra dollars out there weakened the dollar and caused oil to go up and caused gold to go up. Commodities went up. In other words, we had less buying power. Well, all of a sudden, with oil at $100 a barrel and gold at $1,700 an ounce and food at the supermarket becoming extremely, extremely expensive, Federal Reserve started to get really criticized. People said, hey, stop quantitative easing. Every time you guys initiate another quantitative easing, what happens? My dollar loses buying power. Every time gold goes up, I don't care if gold goes up. I don't have a position in gold. But every time gold goes up, I'm thinking to myself, great, food at the supermarket just got a little bit more expensive because every time gold goes up, my dollars are losing value. You know, I'll give you a real-life example. You take a look at the price of gold. Let's see over here what's a good way to explain this, okay? 2000 and, well, my charts don't go back that far. See rates so explains. Okay. Let's go back as far as I can go back, okay? Gold at the time, this was 1,075. Okay, February of 2010. Okay. Feb 2010, gold was $1,075 an ounce. That's how they measure it. Okay. And the Dow was, this is a really interesting experiment that I encourage you to do on your own. Okay, so what do we say? February 2010. February 2010, the Dow Jones Industrial Average was, let's just get the closing price, it's 11,000. Sorry, 10,000. The Dow was 10,000. Okay? Today, okay, gold is 1684. Today, gold is 1684, and the Dow, let's round it to 13,000. We're pulling up 13,000, just to keep the numbers easy. The Dow's at 13,000. Where am I getting at here? Well, instead of looking at the Dow, 99% of us, we take a look at the Dow Jones Industrial Average, and we say, well, the Dow's at 13,000, and it was at 10,000, so that's good, we made money. But my question to you is, how much gold? Because remember, our dollars have lost value. The dollar that you have right now in your bank account is worth less than the dollar was a couple of years ago. The Dow is at 10,000. Divide that by the price of gold. How much Dow could you buy with an ounce of gold? The answer is 9.3. What is it? It's 9.3 points on the Dow for every ounce of gold. And that was in 2010, right? 2010. Right now, I just have my calculator out here. Right now, 13,000 Dow divided by, and we said gold right now is at 1684 divided by 1684. We're now looking at 7.7. Today, 7.7. Okay. In February 2010, every ounce of gold was buying 9.3 points on the Dow Jones Industrial Average. Today, an ounce of gold buys 7.7 points. In other words, I would argue the Dow is actually lower than it was in 2010. Now, I know it's higher. 13,000 is higher than 10,000. But it requires a higher gold price in other words, more gold to buy the same Dow. What you want to do is take a look at everything that we buy. A TV set. We buy a flat screen TV for $500. Gold, let's do it the easy way. Gold went from 1684, or I should say it went from 1075, 609. 609 divided by 1075. Gold went up 57%. 57% in the past couple of years. Did the price of a TV or whatever we're looking at go down by 57%? Why is oil that much more expensive now than it was a couple of years ago? Is it because we have more demand, less supply? It's actually the opposite. We have less demand. We've had one of the warmest winters on record, and we have an unbelievable amount of supply. We're talking about oil every single day, the price of oil every single day, the price of gas every single day in the news. But we buy gas with dollars, but our dollars are worth less. Question is, aren't they buying long-term high-rate bonds to sell low-rate, low-yield bonds? You are correct. The difference, by the way, between quantitative easing and Operation Twist, everyone criticized the Federal Reserve is, hey, stop quantitative easing. Every time you guys have another round of quantitative easing, what happens? My dollars lose value. So what they did, they said, okay, we're going to continue to buy long-term treasuries because the economy is still in trouble. But instead of printing more dollars to do so, we're going to stop the printing presses. We're going to sell our low-yielding maturities. This is Operation Twist. Operation Twist. And from what I can tell, they're continuing with this. I think it's through June of this year. Okay. Buy long-term treasuries. Sell short-term treasuries. But remember, the yields go in the opposite direction of prices. Buy long-term treasuries. When you buy something, the prices go up, but the yields go down. That's what they want. They want the 30-year bond yields to go down. It's actually 10 to 30-year maturities. Those are long-term. Short-term is 1 to 7 year or 1 to 5 year. I forget exactly what it is. If you Google Operation Twist, it'll give you the exact increments. But in other words, they're buying long-term treasuries. They're selling short-term treasuries. They want long-term treasury yields down, long-term yields down, and they want short-term yields up. I'm typing this in because I know it's kind of hard to keep track of sometimes. In other words, they're compressing the yield curve, which is the difference between long and short-term yield. Well, this is good for the economy because this, on the surface, it's good for the economy because it stimulates, purchases. 30-year bond, 30-year mortgage. What's a 30-year mortgage rate in the U.S.? 3.8%, I believe. That's unheard of. That's record book kind of low mortgage yields. That, in part, is because of Operation Twist. But there's one sector that this is very bad for. I'm not going to say it yet, see if anybody knows. There's one sector that this is very, very bad for. This Operation Twist. Long-term yields go down, short-term yields go up. Think of the sector. Exactly right. 100% exactly right. The number one The primary way that banks make money, I know we're running short on time here, so we'll I don't want to get too much off track here. But the primary way that banks make money is what happens. I walk into a bank, I say, I want to open a savings account. Here's $1,000 I'm putting in my savings account. They're going to give me the equivalent of a very short-term bond. 2-year bond yield right now is 0.33%. 33%. That's by the way, a 2-year U.S. bond yield. Long-term bond yields, 30-year, currently pays 3.24%. 3.24%. They're going to pay me in my savings account short-term bond yields. Somebody else walks in and says, I want to buy a house. And I want to buy a house. I want a 30-year mortgage, 3.8%. We'll use a 30-year bond. It's easy. 3.24%. So they're paying me for my money 0.33%. They're lending out the longer-term yield at 3.24%. Operation twist, bring short-term yields up, long-term yields down. Next thing you know, that's the bank's profit margin. The banks are making less money every day they're doing business. Now, I'm not defending the banks, but if I was a stock trader, I would not want to go long any banking stocks because this is fundamentally not good. And from today's statement, I'm watching Bank of America, it's up a little bit, but again, $8 a share. It's kind of hard to, figure out which way it's going to go at $8 a share. But I would not fundamentally want to own any banking stocks based on Operation Twist. And from what I can tell, it's continuing through today. So to recap, Fed leaves rates unchanged. Operation Twist? No. Federal Reserve, 74% chance that they'll raise interest rates by the end of 2014. That's higher than it was before. Operation Twist, it looks like they're continuing, I think, at least through June. They didn't give us a lot of information, and I haven't read the statement yet. In terms of the stock market, well, quantitative easing would have been good for stocks because that's more stimulus. We didn't get QE3, but we do have Operation Twist, and the Fed seems still to be, at least in the language that I read, they seem to be very receptive of economic numbers and very sensitive to economic numbers, and they're very willing to consider more policy if the economy needs it. Specifically, they're looking at unemployment levels and inflation, which they don't see rising at all, and GDP that really is not really going anywhere so far. So that's what the Fed's watching. Those are the economic numbers that I'm going to watch. And those are the next big events also we should watch. Non-farm payrolls, we just had some good numbers. Next big number, CPI and GDP. Those are the big numbers, next big numbers we want to watch. But in terms of the stock market, the VIX hit 15 today. So we've had a lot of stimulus. We've had a lot of really strong stock market days. The Dow's above 13,000. The S&P's almost at 1,400. The NASDAQ is above 3,000. These are big, big levels. I mean, we're looking at pre-recession levels on the stock market. Ask yourselves a question, and I don't mean to influence you one way or the other in terms of your stock trades, but ask yourself the question, is the economy today as strong, stronger, or weaker than it was pre-recession 2008? Before the stock market crashed in 2008, does the economy look better or worse than it is now? Or does the economy now look better or worse than it was at that point? The VIX tells us, the VIX doesn't know about any of this. All the VIX knows is the price of options. So the VIX is telling us, look, we don't know anything else, but we know that people are very, very comfortable. Nobody's buying options. Nobody's hedging their positions. And the positions are, relatively high. Going to the foreign exchange markets, if the current situation continues, meaning current situation, no quantitative easing, economic numbers continue to improve, no great tragedies, no great black swan events, nothing like that, no tsunamis, no wars, nothing like that occurs, I would expect a strong dollar. And my favorite trade, strong dollar, is a strong dollar against a Swissy, a yen, and my third choice, maybe a tie for third, is maybe the euro as well. Euro, we're kind of betting on a black swan event, but I would definitely not go long the euro dollar. If I was going to play the trade, it would be to short the euro dollar. But the dollar yen and the dollar Swissy, we had central banks, the Bank of Japan, Swiss National Bank, they both intervened. They both want the dollar yen, dollar Swissy to go up. Everybody, it seems, wants the dollar yen and dollar Swissy to go up. So those are my two favorite trades based on what we have now. Of course, everything can change in a moment's notice. But that's where we stand right now. As of right now, I'm out of time. If you have any questions, you can contact me directly, www.forexplans.com. By the way, if you go to this website, on the front page, there's a very interesting article about the VIX that I just published a little while ago. So join us there if you like. Again, I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot to talk about the rest of this month. Again, we thank you for joining us. We wish you a great day. All profitable trades. And we look forward to seeing you back soon. Back inside.